Good morning to everybody. I am Sena Ratna, a chartered valuation surveyor. In fact, I was the former government chief valuer, and I have experience in valuation field for about 49 years. So I work as a visiting lecturer since 1998 for MSc course, of course, for the inception in 2007. Today, of course, I don't go to discuss with you the syllabus. I'll come out with that on the next date. And today, direct to the topics we have to discuss. Valuation 2. Introduction and payment of compensation for compulsory purchase. Really speaking, our main area to discuss is assessment of compensation for lands acquired from private parties. For that, we have a different law in this country. Before that, it is better for us to know about valuation and what we are doing. Really speaking, the background of valuation is better for you to know. By now, of course, you might have already learned, but it's my duty to explain the same thing again for your further information. What is valuation? Valuation is a process of finding the present value of a future income stream of an interest in a property based on the past information. Valuation is a process of finding the present value of a future income stream of an interest in a property based on the past information. What does it say? As valuers, first of all, you have to take into mind we don't value assets, lands, building, and other assets in a way. Especially with land and building, what we assess is the value of an interest. Interest means an ownership. Why? You can't transfer, you can't have a transaction on land and building. Although you sell land and building, they are there. Therefore, we are selling the ownership, the interest. First, take that into your mind. To do a valuation, there should be some sort of interest or ownership. I'll be discussing with you different types of ownerships in time to come. And Basically, what you have to keep in mind is we are not valuing land and building, we are valuing interest. Look at the definition. Valuation is a process of finding the present value as at today of a future income stream. Every property has an income stream. It means they generate income to the owner. In a way, it's an investment. Although you buy your land and build your house, and also, or you buy a house for you to live, you have to spend some money. For that, you get a return. What's the return you get? You occupy that building property without paying any rent. So the return you get is the rental value. Like depositing money in the bank. When you deposit your money in the bank, they will pay us interest. That's the return, the yield you get. That's the basic principle. Okay. The process of valuation will involve collection and analysis of market data, past information, finding the chain of return on income, future income stream, and finding a discount rate or capitalization rate in order to arrive at the present value. Discount rate, we call it capitalization rate or YP, years purchase in perpetuity, or discounting rate, depending on the method you apply. Finding the chain of return on income, year by year, you get some income from a property. And to find out the market value as at today, we must have data, we call them past information. Maybe sale of lands, maybe sale of private built-up property, or maybe rental value in the open market for us to analyze and determine the future income or the value of that particular property. The simple process is given there. To do evaluation, you must have data. Data we collect from past information, past transactions, and we analyze and determine what sort of income we can generate from that particular property. And we estimate the future income year by year. What will be the income that will be generated by that particular property? Then future income, we have to bring back them to the present value, today's value. For that, we need a discounting rate. The discounting rate, depending on the method of valuation you use, we call years purchase or discounted rate. As all of you have learned by now, if you are adopting the industrial method of valuation, we need to determine on a YP, that's called years purchase in property, capitalization rate. If you are using the discounted cash flow method, then we need to use discounted rate. That's also based on the yield generated in the open market. the interest rate. We'll be discussing them in length at the proper time. Okay. Valuation is fundamentally an exercise which seeks to answer the question of price. Usually, the price of property interest would sell for valuer values only interest in properties. I explained to you, we don't value properties. We value interest. Therefore, knowledge in property interest ownership is vital, very important. Fee simple and partial interests. According to the bundle of rights theory, complete real property ownerships or title in fee consists of a bundle of distinct interest. Thus, a theory called bundle of rights theory, that in that bundle there are different types of ownerships. Generally, each of these rights can be separated from the bundle and conveyed by the fee simple owner to other parties for a limited period or for an unspecified duration. The whole details of interest are given there. According to the bundle of right theory, complete real property ownerships. Real property includes the interest, benefits, and rights inherent in ownership. Physical real estate, and real estate is the physical land and appurtenances, including structures affixed thereto. What do you have to get out of this? There are distinct ownerships in a property. We call it a bundle of right theory. That bundle can be separated depending on the different types of ownerships and conveyed by fee simple owner. That's the most important part there. Because only the freehold owner, that's called fee simple owner, freehold owner, only he can separate or sell them in the open market or convey to any other person, except the leasehold interest lessee can do that, can make a sublease subject to the consent of the freehold. Right? Try to understand, it's very important. There are distinct interests in a property. That's called a bundle of rights. That bundle can be separated by disposing them to other parties for a limited period. That means you can lease it out. Leases are only, periods are limited. Or else, unspecified periods means you can outright sell the property by a freehold owner of a property. That's very important. You might have learned by now meaning of real property anyway. In early laws, property was deemed real if the court should restore to dispose owner the thing itself and not merely give compensation for the loss. Thus, if X is possibly evicted Y from his freehold land, Y could bring a real action by which he could obtain an order from the court that X should return the land to him. But if X took Y's respect from him, he could bring only a personal action which gave X the choice of either returning the article to Y or paying him its value. In consequence, a distinction was made between real property or reality, which could be specifically recovered, and personal property, which could not. That's the difference between real property and personal property. In making this distinction, English law follows the natural division between immovable, that is land, and movables, but with one important exception. What's the exception? In general, all interest in land are real property, except leaseholds, which are classified as personality. That's the final meeting you have to get into your heads. In general, all interest in land are real property, except leaseholds, because leaseholds are only term of years. That's called as personal property. Okay. Having said so, for our purpose, for the continuation of this lecture, we just have an idea about the different types of interest in land ownership. I presume that you have already learned them in length, but anyway, just to remind you, freehold interest, the fee simple absolute in possession, again it called an estate without limitations or restrictions. The leasehold, term of years absolute. Freehold we call the fee simple absolute in possession, but leasehold we call term of years absolute. What does it mean? Freeholder can use his property without any interruption, subject only to the state general law. But leasehold, he can't use like that because he is using it absolutely within a term, the lease term. In that particular period, he can enjoy the property without any interruption, only subject to the state law, common law. But after the period, he has to surrender that to the freeholder. Sublease, same. Then mortgage, to get a loan, to get a credit facility, the freeholder can mortgage the property to a bank and gets money. If you defaulted, the property is vested with the bank, the mortgagee. Then the servitude right of way. I have my land facing a road, main road with motorable access. Behind my land, there's another land without access. To reach that land, I grant right of way over my land. That's a legal right granted. That's called right of way. Or else, in my land, I have a good well. You can draw from water from that well. But adjoining land, you don't have water. I allow to draw water from my well. That's also servitude. Right. Then easements is also type of servitude. Generally, we get them when we are supplying electricity to adjoining land. I allow to take the wire over my land. That's an easement. And similarly, to give pipe-borne water to my adjoining land, I allow to lay pipes over my land. Servitude is an easement. Life interest. Generally, our parents transfer their properties to their children subject to life interest. It means the freehold interest is transferred, but until the parents leave, the son or the children can't use those properties, because that should be the parents are using the property and getting all the income generated by them. After their death only, you get the real interest to the property, freehold interest. That's called deferred interest. Now, I did not want you to give details about these ownerships, assuming that you have a better idea. What I want to emphasize is what will happen, as already discussed. Only a freeholder Sinnakkarakaru can grant all other interest given there, from leasehold up to life interest. There's a limited powers with the leaseholder to grant a sublease, to give a sublease to another person, but with the consent of the freeholder. Okay. What I want to emphasize here is, once you grant any other interest out of freehold, the property make an encumbered property, because legal encumbrance is created. Then what will happen to the value? There's no encumbrances, legal encumbrances created out of land. In the open market, you get the free market value for that particular property, for that particular interest, freehold interest. That's called sinnakkaraitie. Neethimaya බැඳීම් රහිත සින්නක්කරයිතිය. Once you make any other interest given here, leasehold, sublease, mortgage, servitude, easements, life interest, the legal encumbrance is created over that property, and that will directly affect to the market value of the property, right? That will be very useful when you are doing a valuation for any purpose. Therefore, whether it's land acquisition, whether it's a mortgage, whether it's a sale or purchase, anything, you have to look into and see whether there's any legal encumbrances created out of that properties, right? If there's any, then that will directly affect to the market value, because market value of that particular interest becomes encumbered, legally encumbered property. Okay, keep that in mind. Characteristics of interests. Value of an interest depends on following characteristics: transferability, ability to use and enjoy, ability to improve, ability to destroy, prevent trespassing. All these characteristics are there with the freehold interest only. He can transfer, he can use it and you enjoy it. Then he can improve. Also, he can destroy and he can prevent trespassing. Even leaseholder can transfer that to a sublease, but with the consent of the owner. Full freedom is not there. Ability to use and enjoy. Yes, he can use and enjoy leaseholder, subject to the covenants in the lease agreement. Ability to improve. That's also subject to the covenants in the lease agreement, indenture of lease. Ability to destroy, subject to the indenture of lease. Free and trespassing, he can do that. Therefore, the most important and most valuable interest of ownership is the freehold interest. Having said so, we'll just turn to the practical process, or the valuation process. Value in practice starts with the problem which comes to him in the form of instructions from a client. Only with correct definition of the property or the interest to be valued, correct definition of the property interest to be valued, and the purpose of valuation. The value of proceed for finding the solution. There another thing comes in. although you know the interest or the ownership of that particular property, you must know the purpose of valuation also to do the valuation. You may do the valuation for compulsory purchase, acquisition. You may do the valuation for mortgage purpose. You may do the valuation for accounting purpose. You may do the valuation for rental purpose. You may do the valuation for visa purpose. Whatever the purpose of valuation, the value differs. Therefore, you must have an idea about purposes of valuation also to do a valuation other than the ownership. So the purposes of valuation, value of a particular interest in landed property is not necessarily the same for all purposes. Keep that in mind. There are two main purposes of valuation, that's called statutory valuation and non-statutory valuation. We'll see what they are. There are four types of statutory valuation, also four types of non-statutory valuation. The base of statutory valuation is for that particular purposes, there's an parliamentary enactment. There are four types of statutory valuations and four types of non-statutory valuation. The base for statutory valuation is there should be a parliamentary enactment, law passed by the parliament. The difference is we can't deviate from the statute. But to do those valuation, general principles of valuation we use. Non-statutory valuations, there's no specific parliamentary enactment to control them, but general planning regulations and other things, general things we take into consideration evaluation now, we have to follow. Now, statutory valuation, valuation for rating. As you all know, rates are levied from properties located in local authorities by the local authority. For that, we have to do a valuation. We call them annual value valuation in this country. Annual value is defined in respective ordinances of acts under municipal council ordinance. under Urban Council Ordinance, under Pradesh Sabha Act, annual value is defined. From that, we can't deviate when we are doing the valuation for rating. Section 327 of MC Ordinance, Section 249 of UC Ordinance, and also Pradesh Sabha Act is defined. The Urban Council and MC Council, municipal councils, the similar annual value definition, but Pradesh Sabha quite different from those two because additionally we deduct a thing called stats about 20 or 15% from the annual value to reflect the law. Valuation for taxation. Property taxes, there are two taxes at the moment. One is the stamp duty. Other one is CGT, capital gains tax. For stamp duty, general open market value is taken, but if it is a gift, different procedure we have to adopt to value the market value of that particular for a gift. CGT, capital gains tax, we have to do a valuation as at 30th September 2017 and also to do a valuation as at today, the transaction price. Taking the difference between two, they charge 10%. Only investment properties are involved in capital gains tax. Valuation for compulsory purchase. We are going to learn it in length. When a private property is acquired by the government for a public purpose, the government has to pay compensation to the owners. For that, to assess compensation, there's a procedure given in the Land Acquisition Act. We can't deviate from that. And the fourth is valuation for planning compensation. Unfortunately, our law is not that wide in this particular section. Clearly speaking, no particular laws for planning compensation in this country still. For example, now you are aware of the construction of highways, expressways in this country. If a land is divided into two, and a small portion in left-hand side and major portion in right-hand side, only the access is only to the right-hand side portion, but left-hand side portion you don't have. That particular thing, we consider the Land Acquisition Act several standing years of action, but other than that, if that land is used for residential or commercial purpose, the value comes down to maybe agriculture. So those are called planning situations. So differently consider those instances. Especially when zones are determined. One particular property is situated, we'll take Colombo City. If the UDA implements new zones in Colombo City, right? The highest value we realize in commercial zone. Later on, the planning authority decided to change that zone to residential. Value comes down. You can't expect the same commercial value to be realized for that particular land for residential purpose. Something lower than that. Such instances, the planning authority has to pay compensation to the affected parties by the new zoning. That's the best example. But no such laws are there in our statute still. Okay, that's statutory valuation part. We'll go to non-statutory valuation part. As I already mentioned, for non-statutory valuations, there are no specific parliamentary enactment, specific laws how to do them. Generally, we do them based on various principles of valuation and subject to other common laws affecting properties. That's planning regulations, example, building limits, the street lines, zoning, and this arcade line, likewise, things which you are going to learn. Okay. Whatever the purpose of valuation, the main concern is to find out the market value of an interest in the property, market value of an interest in the property. Market value has been defined as below, generally. Market value means estimated amount of money for which an interest in the property ought to exchange on the date of valuation. There should be a date of valuation between a willing seller and a willing buyer in an arm's length transaction after proper marketing, whether wherein the parties had each acted with full knowledge, prudently, and without compulsion. The buyer is not forced to buy that land. He has an idea about the future development and the present development, knowledge about the property. And it's an arm's length transaction, not a close person to him. It's a friend or even a relation or even family member also. That close relationships do not reflect the correct market value. There may be good understanding, therefore, a reduced price may be determined. So I don't want to explain this whole thing, market value, since we have already learnt it. If I summarized what we learned up to now, it's very simple. What you have to keep in mind is when you are doing a valuation, two things are important. One is the ownership of the property or the interest in the property, in that particular property. It's further explained whether that interest is encumbered or unencumbered. To ownership, you have to know. Secondly, you must know the purpose of valuation, because for different purposes, valuations differs. Sorry, I think I did not explain this valuation for mortgage purpose, valuation for accounting, valuation for mortgage purpose, of course, not only market value, we have to report the post value, sale value also. Then valuation for accounting purpose, we have to follow accounting standards when we do the valuation for accounting purpose. The international valuation standards are there, the local valuation standards are there. So you have to follow them and do the valuation. IFRS 13, IFRS 16, IFRS 17, IFRS 40, like that, likewise. So they have different standards to do valuation for financial reporting or accounting. Then insurance also, you must know for what. There are two types of insurance valuation based on reinstatement cost, based on uh, indemnity valuation. So when you learn insurance valuation, of course, you will get a real idea. Sorry. Okay. Now what I said was, when you are doing a valuation, before doing the valuation, you have to have two things in your mind: purpose of valuation and interest of the property. Those are the two important things even before doing the valuation. Okay. Basic principles of real property valuations. Principle of change, supply and demand. There are 7 or 8 basic principles. Of course, I am not going to deal with all, but generally 2 or 3 things I may deal. Market value fluctuate irregularly, up and down over the years for many reasons. Maybe due to social, economic, and government forces. After several years of ownership, equity reversion to be the same as its original cost. Hence, valuers tend to concern with community, neighborhood, and economic trends as indicators of future change in value. Principle of change is very important. Now, if we really look at the property market in this country, there was an increasing trend in the real estate market up to Easter Sunday attack on 21st April 2019. Because of this attack, that severely affected the real estate market of this country, since tourism came down. One sector is severely affected, tourism sector. Followed by the COVID-19. COVID-19 started in March 2020. That was severely affected to the whole economy. Property transactions were not taking place. A lot of economic distresses came up. And subsequently, the country was declared bankrupt in 2022. The prices skyrocketed. The building costs of building increased to 150% like that. And that condition prevailed until early 2024. After 2024, of course, the market is now realizing some increase in trend, and 2025 and 2026 are normal market conditions are prevailing in the country. Therefore, when you are doing valuation during this period between 2019 and 2024, you have to be very careful. Okay. Second, principle of substitution. This is very important. This principle affirms that the limits of prices, trends and rates tend to be set by the prevailing prices, trends and rates for equally desirable substitutes. Or the principle of substitution states that when several similar or commensurate commodities, goods or services are available, the one with the lowest price attract the greatest. You got a very high price for your property, but the buyer finds similar property for a lower rate in the open market. So he will go to the substitute. Therefore, principle of substitution is also important. The principle of contribution. Value of an item in production is measured by its contribution to the net return of the enterprise, or the value of a particular component is measured in terms of its contribution to the value of the whole property, or by how much that part's absence detract from the value of the whole. Simply adding one room to your house with the permission of the local authorities, it contributes to price the value of that particular property. Or else you are doing your landscaping and other alterations to your property. They may contribute as a part to the main property for increase the value. The principle of contribution. Principle of anticipation. Value is the present worth of expected future benefits. So all values are anticipation of the future. Capitalization rates are based on this principle. It means always you expect capital and rental appreciation of properties and time goes on. Again, as I mentioned, during the period of 2019 and 2024, you have to compare that with the present date conditions of the properties, and then during that period, if you are doing some valuation, you have to be very careful. Now, having learned basic principles of real property valuation, we'll see what are the rights or powers of government over private properties. The government charge taxation. As I mentioned earlier, for your own property, you are supposed to pay taxes to the government or the local authority as rates. If there's any transaction, you have to pay stamp duty to the government. Also, after April 2018, 1st of April 2018, for all the property transactions, you have to pay capital gains tax, as I mentioned, based on the value, based on the difference between the value as at 30th September 2017 and today, or the date of transaction. Eminent domain. Eminent domain means the compulsory purchase of properties. Land acquisition. Anytime if the government wants your land, private land for public purposes, government can acquire such properties with your consent or without your consent under the Land Acquisition Act or Acquisition Acts statutes. That's called eminent domain. Then planning powers, as I mentioned, the planning authority for our country is the Urban Development Authority. Before that, of course, you must know, before 1978, Town and Country Planning Department was the authority for planning regulations in this country under Housing and Town Improvements Ordinance and Town and Country Planning Ordinance. Under both ordinances, the Town and Country Planning was the authority for planning regulations. Subsequently, since 1978, those powers were taken over by the local Urban Development Authority. Now, Urban Development Authority is the authority for planning powers. They make them and all local authorities implement them. Plan regulations. It's cheat. Right to have title ownership of a property returned to the estate if the owner dies and leaves no will and no known or ascertainable heirs. If a person dies without a last will, or there's no any heirs to take over relations or heirs for that property, automatically such property is vested with the government. That's called public trustee. So then the public trustee manages all those lands for the state. We started with what is valuation. Valuation is a process of finding the present value of future income stream in an interest in a property based on past information. We learned that. Now look at this modern method of valuation, what they say. I wish all of you are known about modern methods of valuation. Generally, we call it and use it as the handbook of valuation because everything what we want to know is given there. Valuation methods, how they created, how they formed, and other legal backgrounds also. The modern method of valuation says valuation is an opinion. Different valuers could well place different values on a particular interest at a particular time because they are making estimates and there's normally room with certain limits for differences of opinion. What does it mean? If two valuers are doing the valuation of the same property as at the same date for the same purpose, you can't expect the similar answer, similar valuation from both. It means value may differ. Why? Because valuation is an opinion. It's not a mathematical solution. Although mathematics are involved, we can get the same result. I don't know. During this artificial intelligence and computer, the packages are there. If you put various things there and you get the same, maybe you get the same result. But still the opinion differs. That depends on the person who is handling it. One thing you must address into mind, the modern method says valuation is an opinion. Different valuers could well place different values on a particular interest at a particular time, particular interest at a particular time, because they are making estimates. There's normally room within a certain limit for differences of opinion. What is this certain limit? You must have knowledge about this certain limit. Generally accepted limit is 10%. Your valuation with compared to other person doing the same valuation, the limitation that can be 10% up or 10% down. Who decides the limit? I think time permits you will learn it. The negligence of valuation. Professional negligence control this has determined this limit. Right? Really speaking, that has been determined by the court of law. The difference, 10% difference allowed. There are certain cases they allowed about 15% difference. That's depending on the circumstances. There may be a 15 difference, there can be. But in England, only one case is there. They determine 17% difference. That's because of a special circumstances and a special reasons specifically for that particular property. Forget about 15 or 17%, 10% difference, then there can be, but not more than that. There's difference more than that, something radically, theoretically wrong. Okay. Now, ladies and gentlemen, if I summarize what we learned, Again, what you want to know is valuation is an opinion. That opinion is based on market data. Then, to do a valuation, you must have first decided two things are important. One is the ownership of the property. Second one is purpose of valuation. Okay. When you take the interest, most valuable, most important interest is the freehold interest. Sinnakkaraitie. If the Sinnakkar Karu that freehold has granted any other interest out of his land to any other party, then the property get encumbered. Encumbered property does not have the same value in the open market with compared to unencumbered property. One. Then the purpose of valuation, I categorize them into two categories: statutory valuations and not statutory valuation. Statutory valuations also four things. Not statutory valuations also four things. For statutory valuations, there are parliamentary enactments and we can't deviate from them. We have to follow the statute. But for non-statutory valuation, there's no specific parliamentary enactments passed, but the common law affects, especially statutes relating to properties. For instance, you can say take Rent Act. We are going to learn Rent Act. Under Rent Act, if a property is protected, property is the protected tenant under the Rent Act, that will affect to the market value of that particular property. If you are doing the mortgage valuation, then you have to see whether the impact by the tenancy. Without studying that, we can't do the valuation. And also similarly, planning regulations, street lines, building limits, and this arcade line and things like that, they affect the value. And for non-stat valuation also. So that's the summary of what we learned up to now. Now, second part of this lecture, valuation for compulsory purchase. Commonly we know every government has their own projects for the benefit of the general public. To make some services and facilities, especially the road network of the country. For that, if the government has their own lands, state lands, no problem. If they don't have state lands or the lands owned by the government, you have to acquire private properties from the private owners. In such instances, you can't just take over the lands like that. You have to pay compensation to them. Therefore, we also have a act called Land Acquisition Act number 9 of 1950. We are going to learn that in length in time to come. But for payment of compensation, there are internationally accepted and built up legal framework. We can't deviate from them. Principles of payment of compensation, principles of land acquisition and payment of compensation. Therefore, by this first section, I am going to discuss with you about the basic principles of acquisition and payment of compensation. Therefore, don't get mixed up. First, you learn these basic principles, how these enactments are created or made, and anything, any loopholes are there, drawbacks are there. We have to check them and understand them. We must have the background knowledge. So, we are going to discuss the background knowledge in this particular presentation. Now the time is 10:07. I'm taking 10 minutes break here till 10:20, and after 10:20, I'm compulsory purchase called expropriation or acquisition. Land acquisition means the acquisition of ownership of private property by the state on behalf of the public through a special legal process for the use of the community. The long thing summarized here. Land acquisition means the acquisition of ownerships of private property by the state on behalf of the public through a special legal process for the use of the community. Process of transfer is threefold. Total nationalization of private property rights on political, social, or economic grounds. In the world, there are certain countries, all the properties are owned by the state. And if a private individual wants to develop a property for a particular purpose, residential, commercial, or industrial, they have to get that land from the state and develop it. Most of the socialist countries are like that. Partial nationalization and land reform. The second one is partial nationalization under land reform for equitable distribution of land among community. In Sri Lanka, there were large estates owned by about 80 private individuals before 1972. Agricultural lands. Land Reform Act number 1 of 1972 implemented, and such estates over 50 acres vested with the state government, and the owners gave statutory determination only up to 50 acres. They are highland 50, paddylands 25. If paddy and highland mixed, highland 25, paddyland 25. Or highland 35, paddyland 15. Likewise, maximum agricultural land limit was implemented in 1972 by that act was 50 acres. That's called partial nationalization. I don't know whether equal distribution of land among community was created, but anyway, larger lands vested with the government. Third category, acquisition of private lands for specific public purposes. Public purposes specified and acquired that by the government for the use of the public to give various services to the public. Example, Land Acquisition Act number 9 of 1950. To have a little knowledge about these tools of acquisition, which have prevailed, which we had earlier, and how they developed into present position. A brief knowledge. Tools of acquisition. Post theory. Second, agreement approach. Preemption rights. Third, compulsory purchase approach. 3 approaches are there. Meanwhile, in the United Kingdom, Crown may have powers, and exercise of such powers are called royal prerogatives. In England, royal prerogatives were there, and the Crown was able to acquire, take over private lands in any time during Victorian era. In case of land acquisition, Parliament acts have curtailed such prerogatives, but subsequently, Parliament has enacted some laws to acquire private land, and royal prerogatives are no more there. Doctrine of eminent domain. In the United Kingdom state, the legislatures have power to take private property for public use without the owner's consent by virtue of the doctrine of eminent domain. It reflects the supremacy of the state over the people and their private property. But individual right is safeguarded by not taking private property for public use without just compensation. What does doctrine of eminent domain say? Government has powers to take over private lands for public purposes under eminent domain. But at the same time, the state has to pay fair, reasonable, just compensation for the land taken over. Without compensation, they can't take over lands. Who can make compulsory purchase orders? Government departments and agencies, local authorities, anyone who can persuade parliament to allow them the necessary powers via the private bill procedure. Even corporation and boards, they get powers under their respective laws to take over private property for public purposes. Acquisition against requisition. It's better for you to have some knowledge about requisition of land also. Under requisitions, ownership is not expropriated or acquired, but possession is taken for a time and returned to the owner back. Example, in time of war, under emergency regulations, for urgent government purposes, state purposes, the government can take over private properties under requisition. Requisition means not that ownership is taken over by the government, but only the possession has taken over. If a possession is taken over or requisition is done, it's only possession is taken over for a limited period of time. After the period, the government has to return the possession to the former owners. During the requisition period, they have to pay rents for that particular property. That's the difference. Acquisition, permanent vesting of ownership to the government, pay reasonable or full compensation to that particular property. Requisition, only the possession is taken over for a limited period. At the end of the period, property is reverted back to the owner. During the requisition period, rent for that particular property is paid. Even now some lands are releasing in Jaffna Peninsula, which are taken over by the armed forces at that time in the 30-year war. And for them, they have to pay rent to the owners, and now they have to revert the possession back to the former owners. That's happened. There are different forms of compensation, payment of compensation. A brief knowledge about them also is required for you to have a better knowledge. One form is called the compensatio approach. By this approach, over and above the market value of the property, to indemnify the loss, they pay some additional amount. Or else, other than market value, we can pay restatement value for buildings. Market value determined, then generally to determine market value, take the DRC value, depreciated replacement cost of the building. Then depreciated amount we pay as extra share payment to for that particular property. So indemnifying the loss under Land Acquisition Ordinance number 3 of 1886, 10% additional payment was paid to indemnify the loss. Nowadays, the disturbance part of the compensation, which we are going to learn, cover this provision which was existed in Land Acquisition Ordinance number 3 of 1886. I wish you are aware of Land Acquisition Ordinance number 3 of 1886. That's the first statute introduced in this country during colonial period to acquire private lands for government purpose. Those days we didn't have valuers in this country. According to the historical essays of John Doyle, the government agent in that particular era in southern province, Hambantota, according to his diaries, there are certain notes given how he settled compensation when the private land is acquired. He called the owner to the kachari, and at the inquiry he asked, "How much do you expect for your property?" The owner says, "Amdurwane, 150 rupiah." Government agent says, "No, I'll pay you 100 rupees." Once it is said, owner says, "Very well, sir." So 100 rupees paid as compensation. Those were there. And nice to see, read really. In addition to that, 10% paid for identifying the loss that's given in that particular ordinance. That's called compensatio approach. The second one is pretium approach. That's market value basis. This assumes that owner would be in a position to purchase an equivalent property with the money he gets. When he take the market value, determine the market value, under this pretium approach, it assumes that with that money, he can buy a similar property in the open market. There are certain arguments over that, but for the time being, just keep in mind there are two types of compensation forms: compensation approach and presume approach. As I mentioned to you at the very beginning, we are exploring the history to see how these compensation principles developed. Really speaking, this is compensation is developed on certain legal presumptions. One legal principle is the principle of equivalence. In Latin, restitutio integrum. In 1880, in Livingstone versus Royards Coal Company, Lord Blackburn said, just imagine 1880, 1.5 centuries ago. In setting a sum of money to be given for reparation of damages, you should, as nearly as possible, get at that sum of money which will put the party who has been injured in the same position as he would have been in if he had not sustained the wrong for which he is now gaining his compensation or reparation. Just look at how intelligent a statement. Once a property is acquired, when compensation is paid, then amount should be sufficient to keep the person as he was before the acquisition. Right. This is a very important principle of equivalence, subsequently used to develop the compensation schemes. Lord Blackburn. Okay. To keep in the same position the injured person. Even before that, 1865, Earl Chief Justice in Rickett versus Metropolitan Railway Company stated that the company claiming to take land by compulsory process expel the owner from his property and are bound to compensate him for all the loss caused by the expulsion. And the principle of compensation then is the same as in trespass for expulsion. You are trespassing over somebody's land and expel the owner from that particular property. The loss incurred by him should be paid as compensation. Just compare two. Earl CJ's statement and Lord Blackburn's statement. This is prior to the other one. It says all the loss caused by the expulsion as trespass, but here to keep in the same position, same meaning. Then in 1941, Scott H.J. said in Horn versus Sunderland Corporation, the principle of equivalence is at the root of statutory compensation, which lays it down that the owner shall be paid neither less nor more than his loss. What does it say? The owner can't lose anything and he can't gain anything more than the actual damage. Just see three different decisions. First one say when a person forcefully enter land, chasing the owner away, the loss made by the owner to be paid. Then the second statement, it says pay compensation. Compensation should be sufficient to keep the person as he was before acquisition. And recent case 1941 says by the compensation, owner should not get any benefit or he should not lose anything. That means also the keep the person as he was before the acquisition. Based on those decisions, the compensation principles built upon. The second principle, the presumption in aid of interpretation of legislation. Parliament is not intended to authorize the taking of private property without compensation. So if a land is acquired, it is a must to pay compensation to the owners. Now, based on these judicial decisions, and based on these two principles, principle of equivalence and the presumption of interpretation of legislation, the theory of payment of compensation has been developed. Definition of compensation has been developed. What is the definition? Compensation is the amount of money required to make the owner no better or worse off. It means to keep in the same position than if no land had been acquired from him. Just look at it. When the land is acquired and compensation is assessed, that amount he is getting should be sufficient to keep him as he was before the acquisition. Mind you, little, if we think over this before going further, it implies that land is taken over, maybe with the building, he is losing his ownership. For that, we have to pay compensation. Then to calculate compensation, He has to prove his ownership. You have to go to the acquiring officer, and even maybe he has to consult some valuers or lawyers or some professionals to get this adequate compensation. For all those things he has to spend. And he has to attend for inquiries for them, you have to spend. Likewise, a lot of expenses are there. Even if the person was conducting a business there, he had to shift his business to some other place. Or if not, total extinguishment of the business, he is losing his profit he was earning in previous years out of this property. So that should be compensated. Likewise, everything is incorporated in this definition of compensation. Compensation is the amount of money required to make the owner no better or worse off, that is to keep in the same position, than if no land had been acquired from him. Based on that definition, claim for compensation may be involve one or more of the following: compensation for land taken, compensation for injurious affection and severance for land retained if a part of the land is taken over, and compensation for disturbance and other losses. There may be disturbances, living or business or industry, anything. Those things also should be compensated. Sometimes not the whole land is acquired, only a part of the land is acquired. The remaining part is injurious affecting, maybe losing access. Maybe he has to, if a part of the building is acquired, he has to get balance part renovated. To continue his occupancy. As I said, the business premises acquired, he has to relocate his business or even close down his business. Everything should be there. Therefore, compensation for land taken should be there. Compensation for injurious affection and severance for retained land should be there. Compensation for disturbance and other losses, which are concerned about the owner. By analyzing all, we can develop a compensation equation. Compensation equals market value of land taken plus severance and injurious affection to land retained plus disturbance and other losses. Keep this in mind. There are different types of acquisitions and different scenarios are there. So this is the basic principle of payment of compensation, with some deviations here and there. We'll learn them. Market value of land taken. By historical development and mainly based on judicial decisions, the basis of compensation for land taken is open market value. If not, restatement value in certain cases. we look at this open market value and compulsory purchase, they don't tally each other. අනිවාර්යයෙන්ම කර ගැනීම විවෘත වෙළඳපොලේ වටිනාකම. It is to some extent paradoxical that open market value presupposes a free market, although compulsory purchase by its very nature makes the concept an artificial one. The controversy between two words, compulsory purchase, free market. It is for this reason that statutory guidance are so important. To minimize the difference between those two, statutory guidance are there. We'll see what they are. Market value of land taken. The basis for open market value may be existing use value, we call it EUV, development value, or a combination of both. Existing use value. EUV means that the present value is the highest and best use of the property. To be valued, and it must be carried out within the framework of statutory rules of compensation, planning assumptions coupled with demand and additional rules. When we take the existing use value, we determine the first use is the highest and best use of that particular property. Then we have to carry out the valuation based on the framework of statutory rules of compensation, follow all the statutes, planning assumptions coupled with demand when we analyze the market trend, and additional rules taken into consideration. In international valuation standards, highest and best use is analyzed as, defined as, the most probable use of a property which is physically possible, appropriately justified, legally permissible, financially feasible, and which results in the highest value of the property being valued. You should be able to physically put that in the open market for sale, appropriately justified for that particular use, its market value, market is accepted, legally permissible, sale or dispose of that property is permitted by the legal law, and financially feasible. Economically, it's beneficial. then that is the highest and best use of a property. Now, just for explanation and for your information, assume that there's a 8-acre coconut land in a residential area. The highest and best use of that particular coconut land may not be as an agricultural land. If the market evidence shows the demand in the area is for small areas, purchase 10, 20, 25, 30, likewise for residential development, we can assume that this particular land also can be blocked out and sold in the open market. And based on that, we may be able to pay compensation. Legally permissible. At the same time, if we say the extent of that particular land is about 11 acres or 12 acres, can we apply the same procedure for this land also? No, because fragmentation law prevents blocking out lands over 4 hectares, 9.88 acres. It means 10 acres generally. Over 10-acre land, you can't subdivide and then sell in the open market for other purposes. Not allowed. So, land over 10 acres coconut land, we have to value as an agricultural land, where the prices are fairly low based on the yield of the coconut estate. Right? Keep that as an example in your mind. Development value and hope value. In the open market, any particular property may have value over and above existing use value due to the prospects of development. That's what I gave the example based on this. Once development value was dependent purely and simply on market demand. After introduction of planning control legislation, today development value is a function of both planning permission and demand. Lord Denning in Viscount Camrose versus Basingstoke Corporation 1966 says, it is not planning permission by itself which increases value. It is planning permission coupled with demand. Planning permission is there to convert a paddy land into highland. If it is located in an agricultural area, the realizable value may not be that high. But if that particular paddy land is located in a commercial belt, there's a very high demand as a commercial land. Also, if it is located in a residential area, there may be higher value than agricultural value in that particular paddy land with the planning permission. Taking the argument a stage further, In Myers versus Milton Keynes Development Corporation 1974, a threefold constituency elements to market value were introduced, although all three may not present at the same time. This development value principle, when we apply, you must keep in mind, I think that may be discussed in time to come. There are certain issues in that. For example, if a person owns a farmland with his boutique or the shop selling products in the farm is acquired for a public purpose. The demand in the area is very high for commercial and residential use. Then the authority will value that land based on site value, which is very much higher than the agricultural value. In that scenario, if the owner claims loss of earnings for his shop in the land, he may not be paid that amount as compensation, because unless you demolish that shop building, you can't develop the land. When you demolish the building, and only the authority can develop the land and sell it for higher amount. Those complications are discussed later and take into consideration. Just for the time being, keep that also in mind. Now we'll see what are the three elements of market value. As already discussed, existing use value, EUV, prospective development value due to planning permission, value developed. Planning assumptions and modifications. For development value situations, planning permission can take two forms. One is existing planning permission, current development plan. Two, planning permission assumptions, the immediate and future prospects creating enhanced value, zoning, etc. I briefly mentioned about this earlier. I said in Myers and Milton Keynes development comment, threefold constituency element, threefold elements. One is a bare land is there. That land existing use value we take into consideration. Secondly, when that land is developed with the building, then the planning permission is there to develop the land with a commercial building. Then present land value, we take into consideration the planning permission available and we can put a higher value for that land instead of going on the existing use value, existing planning permission. And after developing the land with the building, then we can take the value developed. Okay. Now, what I, if I summarize what we learned up to now, we developed the compensation definition. Accordingly, compensation is the amount of money paid to keep a person as he was before the acquisition, generally based on the market value. But the judicial decision says by the compensation, he can't get a higher amount than the actual value, or he can't get a lower value than the actual value. Therefore, to keep the person as he was, in addition to the market value, we may have to consider the injurious affection and other disturbance components. Okay. Now we discussed up to now the market value component. Generally, market value is all threefold. One is existing use value. Second, coupled with development planning permission, existing planning permission node, uh, planning permission, planning permission also twofold, existing planning permission and planning permission assumptions, right? Then we take that into consideration and do the valuation of market value, right? So take all these things into consideration. Now, a compensation package, major part is the market value of the land acquired. When market value is assessed, we have to consider the existing use value plus planning permission. Planning permission also twofold. One is existing planning permission and planning permission assumptions. So, analyzing all those things, we determine the market value of the property acquired. Then the second component is when a part of the land is acquired, we have to pay compensation for injurious affection and severance. We'll see what it is. When a part of a claimant's land is taken and the part remain is adversely affected by the scheme for which the land is acquired. That's one scenario. Second one is when no land is acquired, but the carrying out of the proposed scheme and though its subsequent use may cause a diminution in the land value. Two different scenarios. First one is generally we find a part of the land is acquired, especially for road widening projects. Front parts are acquired and the part is balance is left behind. Then the balance area is injuriously affected. In such instances, the owner is entitled for get compensation for injurious affection. Or else a road trace goes crossing a land, dividing land into two, one on the left hand side, another one on the right hand side. The owner was able to manage that land as one entity before the acquisition. Now there are two lands in either side of the road. Difficult in managing the land, two lands, than earlier. That's called severance. For that, compensations for severance should be paid. And this injurious affection and severance, that's also twofold. When a part of a claimant's land is acquired, the balance part is injuriously affected, pay compensation. But there's another scenario where no land is acquired. But when the project is carrying on, with the projects in on operation, or else when the project is completed and put into use, by the use, the adjoining properties are affected, which are not acquired, and the value came down. In certain instances, owners are capable of getting compensation. Right? When I can give you a good example, in both cases, we'll see. First scenario, injurious affection when land is taken. This will fall into three main heads. One, value of land taken plus injurious affection and severance to part remaining. Three, other incidental injury. In three different angles, we can look into the compensation assessment. The valuation approach for assessment of compensation for injurious affection. Generally, we call this before and after method of valuation. To assess compensation for injurious affection and severance, we have to apply a method called before and after method of valuation. In that method, first we determine the value of land taken. Part is taken, that land is valued according to the market principles, market value. Then we value the balance part. Okay. Then we value the entire land before acquisition. Before acquisition, the value of entire land is known to us. Then the compensation for acquired portion known to us. Then value of balanced land known to us. What we do is the compensation for acquired land plus valuation for balanced land we add together, and that amount we deduct from the value of the man land. If there's a difference, we pay that as injurious affection and severance. Logical, right? We'll see what is happening. Then separate the above heads. The difference between A and B should be the amount of compensation for severance and injurious affection. There are a lot of complications in these calculations. We can do them. We can come across, come to them. We can know them when examples are done. So the injurious affection compensation IA equals value of land before acquisition less value of land retained plus compensation for land taken. The second scenario, injurious affection where no land is acquired from claimant. This may arise in two ways. Compensation arising from execution of the proposed work. Example, acquisition for road development projects. Lands are acquired for road development project. Some blasting operations are taking place to blast rocks to make the roads. The vibration of blasting rocks affect adjoining properties which are not acquired, and we have to pay compensation for them, although properties are not acquired. It's a similar situation here. Because I have my own experience when the Victoria Reservoir project implemented in 1984. The new road constructed from Tannikupura Bridge up to Digana New Town through Nattaramputha unaffected area over the reservoir bed, left bed of the reservoir. Because of the blasting operations at the very beginning, where this, if you know about this Kandy area, this Earth Regency Hotel, there's a very big clock in between road travelers. So when the blasting operations was going on, the houses in adjoining area, building walls were cracked. For that, compensation was paid under this scenario. But mind you, we don't have such provisions in our Land Acquisition Act. But in other countries, especially the United Kingdom, England, they have provisions to pay compensation where no lands are acquired. Their subsequent use, we are not that much concerned about those things, but European countries, developed countries, they are very much considered about this disturbance. Noise pollution. Because of the use of the road by vehicles, There may be added noise to the area that may become noise pollution if they exceed some decibel, like 68 decibel or so. Then if the owners can prove that noise pollution is there, for that they can get compensation by proving that the land value came down. Okay, those legislations are there in developed countries. Generally, when there's no land is acquired, to assess compensation, McCarthy rules are adopted. Therefore, although this section is not in our legislation or Land Acquisition Act, to have a thorough knowledge about legislation behind or the foundation behind compensation payment under Land Acquisition Act, better to know this. Really speaking, I explained at the very beginning, we are learning the foundation, the concepts over which the Land Acquisition Act was produced. Therefore, background knowledge is very essential for us to go further. McCarthy rules. The injury to the adjoining landowner's land arises from acts authorized by Parliament, by the statute. Second, the injury must be actionable but for the statutory authority. Third, there must be injury to the value of land. Fourth, the damage must arise from the execution of the work and not from the subsequent use. So those are the 4 McCarthy rules we apply to determine compensation for no land, where no lands are acquired. What you want to know is, for no land acquired, if a land is not acquired for that particular project, in developed countries, they are entitled for compensation for reduction of the market value of their properties. For that, you have to apply the McCarthy rules and then determine. The third component, there are 3 components in compensation equation: market value of land taken, injurious affection and severance, and disturbance and other losses. Now, we'll have a fair knowledge about compensation for disturbance. Loss sustained by a dispossessed owner with flow from a compulsory acquisition may be regarded as the subject of compensation for disturbance, provided it is not too remote. Second, it is the natural and reasonable consequence of the disposition of the owner. Because of the acquisition that is disturbed to the owner of the property, he have to pay compensation. Disturbance and additional compensation includes cost of removal, expenses incidental to removal, fixtures, fees for settling the claim, disturbance to profits, permanent or temporary, double overheads, adaptation of new premises in certain cases, removal and reinstatement of plant and machinery or its replacements, damage to stock, forced sale of stock, notification of customers, reprinting of stationery, business premises, redundancy payments if necessary, legal cost and other fees, home loss payment, statutory disturbance payments to persons having no compensable interest in the property acquired. Now look at this list. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 items are recognized as under disturbance and other losses to when land acquisition land is acquired. We'll be discussing them further in time to come. But for the time being, you must keep this principle in mind. Generally, first two components of compensation equation, that is market value and injurious affection and severance, are based on market value of the land acquired. Okay. Compensation assessed on market value of land acquired. But when if a disturbance, we don't base the market value of that property acquired. That is, disturbance compensation is based on value to owner basis. Value to owner basis. The personal, the particular person disturbed by the acquisition. Therefore, disturbance compensation is based on value to owner basis, and other two components, market value and injurious effects and severance, are based on market value basis. Keep that in mind. This, of course, I just put for you to just have a look. Land Acquisition Act number 9 of 1998. We are discussing it in the next lecture. The amount of compensation to be paid to any person interested in land shall be, where the compensation is for the acquisition of the land, be based on the market value of that land, or where the compensation is for the acquisition of a servitude over a land, be based on the market value of the servitude. Then additional compensation are paid for compensation for severance, compensation for injurious affection, compensation for loss of earnings, reasonable expense for change of residence. These two are, of course, based on market value as discussed, and other two are based on disturbance. Now just look at this. We identified 16 items in international law, but ours only two things are covered. One is compensation for loss of earnings and reasonable expenses for change of residence. Don't worry, I'm discussing with you this in length at time to come. Then the market value is defined in section 45(1) be the amount which the land might be expected to have realized if sold by a willing seller in the open market as a separate entity on the date of publication of that notice, section 7 in the Gazette. Problem. We have to value the market value, we have to assess the market value of the land acquired as a separate entity. This has created a lot of problems in our country, and we'll be discussing that in time to come. Okay. The meanwhile, it's better for you to learn these two terms in we come across: replacement cost and replacement value. There's a subtle difference between two. Please try to get that. Replacement cost means restatement cost of similar kind and similar type of property in a condition equal to, but not better or more exclusive than its condition as at the time of acquisition. When you are using these technical terms, you have to be very careful when you are using especially replacement cost and replacement value. Replacement cost is as it is. But when we take replacement value, the value of acquiring a property at current prices having utility equivalent to property under consideration, but having material standards designed according to the prevalent market as at present condition. Please make a note of it. In international valuation standards, as I mentioned earlier, market value is defined as market value means the estimated amount for which property ought to exchange on the date of valuation between a willing buyer and a willing seller in an arm's length transaction after proper marketing, wherein the parties had each acted with full knowledge, prudently, and without compulsion. Compare this market value definition with the market value definition in section 45.1 and see whether there's any difference between two. As I mentioned, under section 45.1 in market value definition, we have to consider the land acquired as a separate entity. 20 perch land is there. Out of that, 10 feet wide strip is acquired. What will happen to the market value? As a part of the mainland, maybe a perch value is 500,000. But as a 10 perch long strip out of that land, you can't adopt the same rate because as a strip, nobody will buy that land for buildable purposes. Right? I'm going to stop there for this session. And we'll meet at 3 o'clock for the next lecture. And it's this time, of course, the lectures are arranged to have 2 lectures on the same day, morning 1 and evening 1. We are meeting once in 2 weeks' time. So this week we take 2 lectures, not next week. Week after the next, we take another 2 lectures on the same day, morning 1 and evening 1. Today, of course, I got adjusted to this 8:30 because I had some work there. And next date, of course, lecture will be taken at 9 to 12 and 3 to 6. Okay, I'm going to stop there. Have a nice day.